Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Imaru Casanova, Portfolio Manager, Gold and Precious Metals at VanEck. With over 111 billion in AUM, VanEck offers a range of investment vehicles, including ETFs, mutual funds, SMAs, and other vehicles. And they have long been a leader in precious metals investing. They introduced the first gold equity mutual fund, which is the VanEck International Investors Gold Fund, ticker symbol INIVX, way back in 1968. And their gold ETFs include the largest gold miners ETF, the VanEck Gold Miners ETF, ticker symbol GDX, and they have other gold ETFs too. So we're talking about gold and gold miners today, which have been surging lately. Ima, welcome. Great to have you with us today.
Thank you so much for having me, Nina.
So the price of gold has recently surged to all-time high. It recently surpassed $2,500 per ounce. And this is the first time ever a bar of gold, which typically weighs about 400 ounces, that bar is worth more than $1 million. So what is driving gold prices higher?
That's right. It's I guess psychologically a pretty interesting figure, and I did read that a couple of days ago when gold reached 2,500. The amazing fact that a $400 ounce of bar of gold, it's $1 million, which is pretty cool, I admit. What's driving gold? This year, the gold rally has been very impressive. It's been a strong rally with gold setting new highs almost, every month. And we went from finally breaking through decisively through that previous resistance level around the previous high of 1975 or so to now gold at 2,500. And there are several factors behind that strong performance, but there is some drivers that clearly are behind this rally. And the first one I will mention is very strong central bank gold purchases, as well as very strong buying, very strong demand, physical demand for gold out of Asia. And so both the consumers in Asia, as well as the central banks from emerging markets, and specific the Chinese central bank, have been for sure behind the strength in the gold price this year. Obviously, heightened escalating global geopolitical risk is also supporting gold, and expectations that the Federal Reserve is going to soon start to cut rates is also providing support for gold. So that's what's behind this recent strength. To put things in context, central banks have been buying record levels of gold as a group since 2022, with over 1,000 tons of gold purchased in both 22 and 23. And 24, the first part of 24 has also been of strong buying. And so this group, this center of demand, which has, I would say, historically been really more of a support for the gold price, of a floor setting for the gold price, has emerged in this last couple of years as a true driver of gold prices.
Very interesting. So you talked a little bit about central banks buying gold, and for the past couple of years at least, they have emerged as very important supporters of gold prices, and they have been buying central banks have been buying gold forever for their foreign exchange reserves. It's a part of their external reserves. So, why are central banks buying so much gold lately?
Yeah, I think it is not a coincidence that this recent trend of record level net buying of gold by central banks started in 2022, and more specifically in the second half of 2022. That coincided with the invasion of Ukraine by Russia. If you looked back at our commentary, right around that time, we looked at Russia's reserves and pointed out that with, at that time, about 20% of their foreign reserves in gold, other banks were going to be looking at the Russian experience and the fact that, of course, a lot of their other foreign reserve assets were frozen and unavailable, and other banks were going to be paying attention to that. And potentially that could drive increased gold buying by central banks globally. And that's precisely what happened. After that, a lot of banks, including and especially the Chinese central bank, started to accumulate gold at levels, like I said, that were well above the average for the past 10 years or so. To be clear, central banks have been net buyers of gold for, I think, 13, 14 years, consecutive years now. So net purchases have exceeded sales as a group, but the levels in 22 and 23 were really, really high. And so why are they buying? I think they are looking to diversify their reserve assets. They are particularly looking to de-dollarize their reserves. Like I said, especially after seeing Russia's example. Russia now owns about 30% of their reserves in gold, and clearly that has served them well. And more broadly, the banks, when asked and surveyed, the same question you asked me, why are they buying? The reasons are the same reasons we think investors should own gold. They're looking to protect themselves against inflation, financial risk, geopolitical risk, market volatility, and to diversify and move away from the US dollar. So those reasons, I think, are still there. And we expect central banks as a group to continue to buy gold as they have in recent years.
So let's talk about your gold price outlook now, because the bigger question for investors now is whether this rally can continue, because gold is now up about 22% year to date, and it has outperformed the S&P 500 index, which is up about 19% in 2024. So do you think this rally can continue, and why?
Yes, you're absolutely right. That's the number one question. After such a strong performance this year, it's natural to think, is this a top? Is there more room here? And I've been talking about I'm not a big forecast. I don't really like to issue forecasts on the price of gold, but I was comfortable putting out there some targets based on historical performance of gold, and really just on that. And so, what's the outlook from here? All of the things that I mentioned initially that have been driving gold this year remain in place. Geopolitical risk and tensions around the world are getting worse, if anything, unfortunately. The Federal Reserve is closer and closer. Everybody's factoring in a cut next month. So that's viewed as gold positive. Lower rates generally correlate well with gold prices. Inflation, I think, is coming, has been coming low, but I think a fear, the risk that we could, hit a new wave of inflation once the Fed starts to ease, or potentially that these inflation at the levels that it is now, which is still above the Fed target, could take longer than maybe originally anticipated to bring down to the 2% target. That could also support gold because gold correlates well. Again, gold is usually supported and performs well in periods of higher inflation. Central banks, like we mentioned in our previous comments, we were talking about, they look set to continue to be net buyers and continue to support demand from those centers. The Asian investor, the very strong demand from bars, coins, jewelry from the Asian investors has come down a bit this year, especially last month. I read some of that demand has come down a bit, but that comes from very, very high levels. So we still expect support from there. What has been lacking in this gold rally is a driver that historically has been the main driver of gold prices, and that is in Western investment demand. That has been lacking in this rally, and the reemergence of that demand from the West is what I believe will be the most important catalyst for gold prices from here, and why I do believe that gold prices can go higher from here. I did some quick math. I did it when we did our webinar and other talks, and put it in some of my comments that I publish monthly. If you look at where we use gold, the global bullion ETF holdings. There's not very many ETFs around the world that are bullion backed. If you look at the holdings of all of those ETFs globally, you can get a really good proxy for investment demand. And what you'll see is that over the last few years, as gold has actually been increasing, those holdings have been going down. The Western investor has not only not come in, they've been leaving. They have been completely absent. And so the reemergence of that investment demand, as evidenced by the increase in gold bullion ETF holdings, I think has the potential to bring gold higher from here. And so what I was going with this is, if you look at where those holdings were, say, when they hit their peak, when gold hit the 1900, the previous peak, we're well below those levels. And if gold were to behave in the same way it did when those holdings increase from current levels to those peak levels, we could easily see gold another $200, $300, $400 up from here. So I've put it out there at sort of $2,800 target as a very achievable target, just on the return of the Western investor, and the ramifications for the gold price with that increase of demand from these levels. And I we're talking about gold, but to me the larger and more sort of important implications of that sort of move and the return of the Western investor is really what it means for the gold equities. Because they truly have been hurt by the absence of the Western investor. Unfortunately, central banks don't buy gold stocks; they only buy gold. So the upside from here, that return in investment demand, is very significant for the gold equity space.
Very interesting. Now, you mentioned some of the reasons why central banks have been buying gold, or why investors should own gold in their portfolio. And I wanted to talk a little bit more about the case for gold in any investment portfolio. So when you advise your clients, your investors, what do you tell them, why they should be owning gold, and how much gold they should own in their portfolio? Should they own it because of its diversification benefits, or because it is seen and behaves as a safe haven asset, or as a store of value? And about diversification benefits, I saw a very interesting article in Financial Times yesterday, and their analysis showed that over the past 20 years or so, gold has provided better diversification benefits than bonds for an equity portfolio. So the analysis showed that gold was a better hedge than bonds in the great financial crisis. Then at the end of 2018, when stocks swooned, and then in the 2022 stocks rout. And in fact, the year 2022 was historically bad for the average 60-40 portfolios because stocks had a terrible performance and bonds also had a terrible performance. So since then, investors have been looking at alternatives to bonds for better diversification in their portfolio. So I was interested in your thoughts of owning gold as a diversifier, and how much gold should investors own?
No, it's a great question, and obviously one that we're asked very often. What I tell our clients, prospective clients, investors more broadly, is if you don't own any gold in your portfolio, you should really consider owning some. We're often asked, like, when, how much. When is now. If the allocation is zero, I don't care where gold is at, what price is at. If you don't have any gold, yeah, maybe you can try to, pick a day with a bit of a pullback, of a correction. But more generally, I advise that investors do not try to time the gold market. I've been covering the sector for 20 years, maybe a little more. And, there's no timing it. And so if you don't own any gold, you should own it today. You should own some. And the reasons for owning it, the other way I think maybe it's very translatable, is you think of gold as insurance in your portfolio. And I know it's maybe kind of silly, but I make the analogy of like health insurance or life insurance, right? You own it. If you don't have it, you get it. And you don't question whether you should get it. You just get both. And you don't wait until, you're feeling a little sick to get it. You get it well in advance of that. And then you just have it, always have it. And I think of gold because you don't know when you're going to need it, but when you need it, it's very important that it's there. So I think of gold in the same way. It's portfolio insurance. You own it and you let it do its job when it needs to do its job. And you mentioned the circumstances and the events, financial crisis, periods of heightened risk, periods of high volatility, periods of escalating global geopolitical risk, all of the factors that drive gold. When gold needs to do its job, it does. So that's how I view gold. It's insurance for your portfolio. Now, the benefits of owning gold, you also covered. Gold in a portfolio, because it has so low correlation, not necessarily negative in all cases, but in some, but it has such low correlation with pretty much every asset class. It is a great portfolio diversifier. And as you mentioned, when we look at portfolios that have some gold exposure, their risk, it does impact favorably the risk-adjusted returns of those portfolios. And so it's a great hedge against inflation and all the other sort of bad scenarios that I described, but it's also a great portfolio diversifier. And then when you look at then how much, a lot of times we talk about all these benefits, but really, are you going to own 5%? If you own 0.5, 1%, less than 1% of the portfolio, you're really going to feel the effects of gold? I don't know the exact answer, but from some of the studies I've seen on sensitivities around the exposure, and by the way, when I say gold, and we can talk about that in a minute, I mean gold asset class, which includes gold bullion and gold equities, which obviously are different, but they should be considered as an asset class. What percentage? I tend to think the sweet spot is around 5%. If you have much less than 3% in the portfolio, the effects that those benefits that I highlighted before are I'm not necessarily sure you're going to feel them. We probably don't recommend much more than a 10% allocation, and so 5% seems to be what we seems to be a reasonable allocation. Obviously, has to be customized and evaluated and considered based on every investor's risk profile and time horizon, etc. But that's typically what we tell our investors when they ask about how much gold they should own in a portfolio.
Excellent. I agree with you. 5% is a very reasonable allocation for most investors. Now let's talk a little bit about silver too, because gold is not the only precious metal which has been shining this year. Silver is also up more than 25%. So tell us what is going on with silver and what's your outlook on silver?
Yeah, so silver has, it is also a precious metal. It historically trades with gold. So, if gold is doing well, silver generally does as well, because it is viewed as a financial asset as well as a currency, if you might. It does play that same role. More recently, now of this year today, like you mentioned, if you just look at year to date, silver is actually outperforming gold a little bit, but that comes on the back of very strong underperformance over the last several years. I like to put things in perspective. I like to look at the gold to silver ratio. So if you take the gold price and you divide it by the silver price, what number do you get? I think we're somewhere around 85 or so. Currently, it got as high as 100. So, but it's pulled back, like I said, this year. If you look at the historical, I don't know if it's 10 or 20 years, but going back, that number is closer to like 60 or 65. And so silver really is still lagging gold, which is why at the beginning of this year, I was very bullish on gold, and I still am. But I was particularly bullish on silver because I knew that I had some catching up to do. And so we expect our strong and bullish outlook for gold to also be very bullish for silver. And silver has another aspect, which is worth mentioning, which has the potential to enhance that outperformance that I'm talking about. And it is that it does, unlike gold, it has a very significant industrial component. Gold industrial component is very minor, very small, almost insignificant. While silver, the industrial demand represents a significant part of demand, and that has been increasing. More recently, that the demand is set to be increased strongly from the fact that silver is used in solar panels. It's an important component of solar panels. And so if we get the sort of explosive growth in solar panel and solar electrification that we expect as far as this drive towards renewable, then silver is set to benefit with a big growth in demand, which is not necessarily going to be met by a response in supply, simply because silver supply, as well as similar to gold supply, is very inelastic, and so that should have important consequences for the silver price. And so we like silver a lot, and we think it's got a strong outlook from here.
Great. Now, you mentioned gold equities earlier, so let's talk about them. And these equities, these stocks had lagged the performance of the metal earlier this year, but I noticed that they have been rising lately. And now your ETF, VanEck ETF, GDX, which is the gold mining ETF, it is up 30% year to date. So these miners, they are seen as high beta plays on the price of gold. So what is your outlook on gold miners? And then part two of this question, could you tell us about some of the gold mining stocks that you like?
Sure. Yeah. And so I run a active gold equity fund. So the equities are my sweet spot. And so I welcome the questions on this part of the gold asset class. You're correct. The stocks had, for the past several years, really been lagging the gold price. In the second quarter of this year, we finally saw them display that leverage to the gold price that you made reference to. In a rising gold price environment, because of their strong leverage to the gold price, gold stocks should outperform gold, and vice versa, of course. If gold is trending down, the equities are likely to underperform the metal, and that hasn't been the case for a while. But in the second quarter of this year, we saw that strong leverage reflected in the stocks. And like you mentioned, now as of today, year to date, the stocks are outperforming. And so I mentioned in my previous remarks the fact that the Western investment demand more broadly for the sector has been really non-existent in this last rally. And so that we're, like we said, we're very bullish on the gold price. We're even more bullish on the potential for the gold stocks to continue to rally from here as that investment demand comes back. I think it's important to point out that if you look at the GDX, for example, if you look at where those stocks, where that index and gold stocks in general are trading, they're nowhere peak levels. So yeah, gold keeps making new highs every month, but these stocks are still very well off their peak. So there's quite a bit of runway here. I think if you looked at where the stocks, I forget what, no, it was probably the GDM, the index, but the GDX, same thing. If you looked at when the stocks traded, where they're trading today, the gold price was $1,800, $1,900 per ounce. Today, we have a $2,500 per ounce price, and the stocks are trading at that same level. So it gives you an idea of how oversold the equities were and the potential that they have to re-rate from here if we continue with this strong gold price environment. So I'll add that we're not positive on the equities just because of the commodity landscape, but also because the companies themselves are well-run businesses today. Costs, which did increase as inflation hit in 22 and 23, are now seem to be contained and under control. So with the gold price increasing as much as it has this year, margins have expanded significantly for these companies, and these companies are producing a lot of free cash flow. And we saw that in Q2 with a very positive earnings season for this sector, demonstrating that yes, when gold prices are higher, our earnings also increase, our free cash flow also increases. And so we have the margin expansion, and we have companies now producing cash that we see them allocating responsibly and in a disciplined manner. They're not just buying for the sake of buying and getting bigger, but they're buying to create value. They're increasing dividends and paying dividends, and they are buying back stock, and they are investing the capital that they do invest in growth in ways that we consider very responsible, as far as demanding double-digit rates of return, and also de-risking projects significantly so that some of the mistakes of the past are not repeated again. So you look at balance sheets, net debt to EBITDA levels, free cash flow, everything looks good. Balance sheets are very healthy. So it's not just a gold price story, although obviously that's a big factor. It's also a health of the sector story, fundamentals supporting the re-rating that we're hoping materializes soon. And then jumping onto your what stocks we like, it's easy. We tend to, in our active strategy, overweight obviously our top holdings are our favorite stocks. I have two I can talk about today, which are two of the highest quality gold stocks today. Our top holding, Alamos Gold, ticker AGI. And another holding, Agnico Eagle Mines, ticker AEM. Two names that we like for many reasons, but the highlights are for Alamos Gold, a growth story. Growth does not come easy in this sector. If you have growth and you have high quality growth like Alamos does, then the market assigns a premium to those stocks. And we certainly think that's the case for Alamos. They are expanding one of their mines in Canada. It is brownfields expansion, which means it's a much de-risked from that point of view. They're doing it from cash from operations. At the same time, they acquire a company recently, Argonaut, that is going to enhance that project, that mine, and deliver further value creation for Alamos. Their assets in Mexico that were supposed to basically be, coming to an end soon, have found new deposits and new life. So that keeps on going and continue to generate cash flow. The geopolitical jurisdiction profile for Alamos is positive, with assets in Canada and Mexico. And management has demonstrated that they know how to create value, doing value creative acquisitions and managing this growth phase very, very well so far. So we really like Alamos, and importantly, they continue to deliver against expectations, which is something we really like to emphasize. The importance for companies to set targets, to provide a guidance to markets, and their importance of them to deliver against those targets consistently, quarter after quarter. And Alamos has been successful in doing that, and again, the market has rewarded them for that. Agnico Eagle is a similar tone, a larger company, senior company with mines in Canada and also Mexico, Finland, with a strong geopolitical jurisdiction profile again, which is a very important consideration for this sector. I was just at their Detour Lake mine in Canada, which is one of their largest flagship mines, and they're set to expand that mine to become one of the largest mines in the world. So a very exciting project, again, a brownfield expansion, very de-risked from that point of view, with capital requirements that are very manageable for a company at Agnico Eagle size. And so, again, delivering growth, and again, Agnico, a company that consistently meets expectations, and in fact, beats expectations, and has earned a premium in the sector historically for that performance.
Excellent. You mentioned lack of investment demand earlier. So I wanted to talk a little bit about Bitcoin as well, even though I know that Bitcoin is not your core area of focus. So even though gold has done so well this year, US listed gold ETFs have seen underwhelming inflows, whereas Bitcoin ETFs have gathered billions. And I understand to an extent, because investors had been waiting for these spot Bitcoin ETFs for almost a decade. But I've been thinking why gold ETFs are not getting more love from investors. Maybe investors have been just flocking to Costco to buy gold bars. So anyway, talking about gold and Bitcoin, many talk about Bitcoin being digital gold. Now, we talked about the role of gold in an investment portfolio and the diversification benefits. However, we have seen that Bitcoin has been quite positively correlated with risk assets. So it's definitely not a safe haven and it doesn't have diversification benefits. It is a new asset class. And if we look at the 5 years performance, it has done very well. But I was interested in your thoughts on Bitcoin being digital gold. Do you agree that Bitcoin is digital gold? And should investors own both real gold and digital gold?
Yeah, no, it's a great question, and again, one we are very often asked. I think naturally because first we are VanEck, very exposed to both asset classes, but also because they are alternative asset classes. They're viewed as an alternative to your traditional broader market equities and other asset classes. And so it is a good question. It's Bitcoin digital gold. I think for many, I mean, it's definitely digital. It is a digital alternative, I think. I, I, I can see how some might equate it and put it in the same, terms as gold. As you pointed out, I struggle with yet, calling Bitcoin gold because it is still very early stages. And as you also pointed out, we don't quite know exactly what its role in a portfolio is going to be. Gold has a very long history. You walked through some of the performance over the past 20 years and how gold has performed and the benefits that it has offered. And it's very well defined and also just very well supported from just what its role has been historical. So we have that. We have that centuries of track record for gold. We're building that up for Bitcoin. And in fact, like you said, is it a risk off or a risk asset? It's hard to say. It's still, but we do know is that it is an alternative. We do know that it is more isolated from some of the risk of the broader financial system, perhaps. And some of those features are similar to gold and therefore could be perceived as an option to gold. I think it's more likely that those that invest in gold also want to invest in Bitcoin, although I do think it is a very different investor base. Not sure how much of an overlap there is. I don't think we're seeing gold necessarily be replaced with Bitcoin. I think it's more of a combination or just each asset attracting a different demographic, a different geography. So that's how I view it. And so why then, do you see this? And again, you set it up perfectly. There was a lot of pent up demand, of course, with us included, waiting for all these products to be approved. And of course, once they were, we obviously get this rush of assets flowing to those asset classes. But I also think it has to do with what kind of asset classes, again, they are. Are they more like tech stocks, and are they perceived as those being able to produce those spectacular returns that we've seen from the Magnificent Seven and the Nasdaq and the recent performance of that sector? And that's just, Bitcoin is just riding that wave. Gold has not benefited from that as a very strong, broader equity market here in the U.S. has detracted from gold as an investment. Nobody feels the need to own gold in times where, everything's to be going really well somewhere else. And so I think the lack of the poor sentiment and the apathy towards gold as an asset class has, impacted the gold equities the most. It's natural to think that the first step is investors jump into the commodity, and then maybe as they get comfortable with the fact that this higher gold prices are here to stay or here for longer, then the equities start to feel some of that to attract more investments. But you're right, we have certainly not seen the inflows yet into the asset class, which gives me more reason to be bullish on the outlook from here for the gold equity space.
Great stuff, Ima. We'll have to leave it there. Thank you so much for joining us today and for sharing your excellent insights.
Thank you, Nina, for having me. I appreciate it.
That was Imaru Casanova of VanEck. Now let's talk about ETFs and a mutual fund that you could look at. So the mutual fund that she manages, and she mentioned, is the VanEck International Investors Gold Fund, ticker symbol INIVX. And I did mention that VanEck offers 2 gold mining ETFs. The largest gold miner ETF is VanEck Gold Miners ETF, ticker symbol is GDX. If you want to invest in smaller gold miners, small cap companies, you could look at the VanEck Junior Gold Miners ETF. The ticker symbol is GDXJ. Now, if you want to invest in physically backed gold ETFs, those are the most convenient and lowest cost ways of getting exposure to the metal. So the Spider Gold Trust, ticker symbol GLD, is the largest and most liquid gold ETF, and it is preferred by traders because of its excellent liquidity. But for longer term investors, there are 2 ultra cheap gold ETFs that I like a lot. GLDM by State Street, that charges just 10 basis points, and IAUM by iShares, that charges just 9 basis points. So these GLDM and IAUM are excellent physically backed gold ETFs suitable for long-term investing if you want that 5% allocation in your portfolio. And VanEck also offers a physically backed gold ETF, which also has the option to take physical delivery of gold. And the ticker symbol is OUNZ, OUNZ, easy to remember. And this recently surpassed 1 billion in assets. So excellent ETF and definitely worth a look. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.